Our base case expectation is not for a recession. We do expect continued monetary tightening.
Russia should absolutely contribute. I think that there is a broad consensus that given, the circumstances of this war of aggression and what has caused, this devastation, of course there ought to be, as part of the overall financing effort, that there ought to be also reparation from Russia.
We are working right now very actively to diversify our gas supplies. We are talking with other suppliers, both via pipelines like with Norway or LNG, where, for example, US has agreed to supply substantial additional amounts also.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. Trade truce. The U.S. could roll back some China tariffs as soon as this week to counter rising prices. Stocks and futures stay broadly higher. Beleaguered German gas giant Uniper is said to be negotiating a government bailout worth up to 9 billion euros. Shares sink as the company negotiates. And 50-50, the RBA delivers back-to-back 50 basis point hikes for the first time ever and does not rule out further tightening to slam the brakes on inflation. So again, inflation, of course, dominating everything we talk about, including some of the markets. European stocks gaining some 0.3%. If you have a breakdown, it's really only the FTSE 100 that saw a bit of a reversal. So we started higher, and now it's and some 0.4%. Again, equities rising as talks between the U.S. and China on removing some tariffs boosted optimism for an easing on inflation. We spoke to our Enda Kern, our expert, of course, there on the ground in Hong Kong, and he says, look, this at the margin won't really make a difference, but it just shows that a lot of the markets are trying to latch on to a piece of good news. We look at technology, gaining 1.1%. Bitcoin, always a good idea to look at Bitcoin. Is it now a hedge? Is it not a hedge? Is it really an asset class? We're expecting also the financial stability report here in the UK from the Bank of England. So let's see if we have more crypto regulation in the UK, currently at 20,172. If you look at the European map, let's get straight to it. Now, we did start on the green overall. The FTSE now down 0.3%, and there is also movement in euro. So the euro weakening, we'll try to get to the bottom of that. We are getting a bit of data. We're trying to go around the newsroom and say, why is there such weakness in euro today? And you can see that sharp fall actually from 8 o'clock London time, probably a bit of dollar strength instead of euro weakness. But we're getting data, euro area June services PMI 53. That's actually higher than expected. Our preliminary, now this is a second reading, the preliminary figure was 52.8, and this again is for the month of June. Interesting because pretty much Germany was in line with expectations for that PMI services, but France was lower than expected. Now, the base case expectation is not for a recession in the U.S. That's according to strategists from Goldman Sachs. Take a listen.
Our base case expectation is not for a recession. We do expect continued monetary tightening. You may well see a technical recession, but what really matters when you're thinking about the investment landscape and opportunities in fixed income sectors is the magnitude and sort of the characteristics of that recession.
Well, we're now joined by Aaron Captain. He's Global Head of Economic Research at UBS. Aaron, how much time do you spend thinking about inflation? This is like, every day of every minute. And how do you model it?
Well, so it's tricky because the models actually don't explain what's going on, right? So they're very slow moving. They usually run off business cycles, and that's not where the action is right now. So all the focus is on supply chain bottlenecks and basically things that usually are random walks. And so what you tend to do is you try to sort of go to the bottlenecks rather than to the inflation and monitor those and then see whether they're easing. And they are.
They're easing, but how many hikes are you expecting from the Fed to keep inflation at around 2%? Yeah,
well, they're not easing fast enough to stop the Fed from hiking. So I think they're going to deliver nearly the entire cycle before you start to see the relief from the bottlenecks, right? So if you look at our bottleneck tracker, which is very similar to the New York Fed, we're still about 2 standard deviations away from normal.
Ugly?
Ugly. Last month, though, it was about 3 standard deviations. So it is now improving. Yep. The question then is, once you eliminate the bottlenecks, how long does it take to get the inflation relief? And right now, you're not really seeing anything in the data yet that gives you a lot of comfort.
So this means what? How many hikes from the Fed?
So 75 at the next meeting, basically delivering, I think, on the SEP. There's a remarkable amount of consensus within the summary of economic projections on how much they want to deliver. So everyone is within 25 basis points or so of the 325 to 350 by the end of the year. So 75, and then you slow down a little bit, and then you basically You do, I think, what is it, 175 bips by the end of the year in total.
So where do you end up in 2 years? I know we're starting, and the market's trying to, to price in price cuts. It just depends whether they really want to hit that 2%. And if they want to hit 2%, there could be a lot of economic pain.
Well, yeah, it's actually impossible, I think, with their policy to hit the 2%, in the sense that you have about 650 basis points of inflation you don't control, and then you've got 200 that you do control, and you can squash that 200 down to zero by basically hiking the housing market into the ground, but that doesn't really offset the 650, right? And so I think it's a little bit of a mix of wanting to do what you can do to take off the froth, which is sort of the Powell narrative, and then hoping that the supply bottlenecks take care of the rest.
Hoping. I mean, that really makes me so nervous. But it is part of, central bank policy is not an exact science. And so dealing with a lot of these economic twists and turns is also not. So I had a panel last week with Jay Powell, Francine Lacqua, and Andrew Bailey. And in it, Jay Powell said, look, the clock is ticking. Do you think that a lot of these central banks, and I know they're all different, need to start dealing with inflation more aggressively now just to make sure that there's not a wage spiral?
So I don't think they're all that. I think they move as a herd, right? And I think we've sort of seen that. So they've all gone collectively from thinking, we're going to hike just to neutral, and then miraculously inflation comes down, and we have a soft landing.
Miraculously, I love that, Aaron.
To now, and RB&Z was the first one, but now they're collectively deciding, okay, we actually need to do a bit more. So we're going past neutral, we're going to become contractionary, and then let's see what happens. So I think there is a little bit of a moment of panic here. You saw it with Powell at the press conference about the Michigan survey, that it's running too high for too long, and now you're starting to see the wage demands come through, and so it's just very uncomfortable, I think, for them to not be aggressive. And so at this stage, I think it's easy to be aggressive, right? You're early in the cycle. Once you get later in the cycle, it gets tricky because you're now seeing the housing market slowing, you're seeing other data slowing, and so the recession models are now starting to sort of signal some caution. And so that's why the market is now pricing those cuts in mid-next year. So
if you look at the ECB, I mean, is there any way that actually inflation expectations do not get de-anchored?
So what's interesting is actually if you look at the hard data, it looks like the U.S. is inflecting before Europe, which is very counterintuitive because, you think the Russia-Ukraine war, you have a collapse in consumer confidence. It feels like Europe should be closer to a recession than the U.S., but actually the data is slowing more rapidly in the U.S. than Europe. So that's the first thing. Now, what you
But we're in different cycles, right?
So we started slightly different cycles, but we're hit by common shocks. So it's somewhat surprising. But the other thing you see happening in Europe is now the wage pressure starting to come through, right? We saw the EJ Metal demands, about 8% is what they want. That has much more sticking power in Europe than in the US, right? So in the US, we've had very hot wage inflation, which is now actually moderating, which is very counterintuitive because the labor market is still super tight. Whereas in Europe, what you're seeing is wage growth accelerating. And so that, at the margin, I think is going to make it difficult for inflation expectations to come down.
What's happening with euro? I mean, I don't want to ask you today because I know it's a little bit, but does euro just weaken from now? Are we going to see parity?
So, what's interesting, we've basically, if you look at the dollar, we've had the biggest 3-month move. There's only 2 instances the last 20 years where the dollar has moved more than basically 3 standard deviations, which is the move we just had. So you've had a very big move, but with not a lot of trending in the dollar, right? So it feels a little bit toppish here. And so the question is, what is your news pipeline and what is priced? And so now historically, in a weak growth environment, the dollar does do well. People basically, they stick close to home. And but I think we've been in a long dollar environment for so long that trade sort of already happened. And so now I think it's about the news pipeline. And so it's basically what is the risk of gas disruption versus, what is the relative pace of central bank tightening? Who starts to sort of pause first? And so our bias is that euro dollar actually starts to sort of go higher now. But you're in a choppy, I think, summer period where, none of the big macro debates are going to get resolved.
And when you look at the UK, I don't know what to do with the UK, actually. Are we definitely going to see a stagflation environment? At the same time, how much help are they getting from this weaker sterling?
So we're all sort of in the same boat in the sense that you're going from historically high growth rates because of the pandemic recovery to something that is much more normal. And so that feels like a recession. And so I think the reason it feels a little bit magnified in the UK is partly because there's even less labor market slack, right? And so ultimately your growth rate is going to settle around, how fast does employment grow and how fast does productivity grow? Now, UK has had terrible productivity growth in the past and now has very low employment growth because we have labor shortage issues. And so I think and we opened up a bit earlier. So that slowdown to that new lower equilibrium is just happening here, I think, first, which is why we're starting to generate some negative monthly GDP prints. Now, it's not clear that's a recession, right? Because this is just the adjustment. It could be, but ultimately, I think the way I think about it is it's levels versus changes. So the changes look terrible. the levels are okay, right?
Right.
If we do not generate unemployment in this country, it's very difficult to sort of see how we'd have a recession.
Aaron, thanks so much. Aaron Captain, their Global Head of Economic Research at UBS. We went around the world in 7 minutes on inflation. Coming up, we'll be joined by AI pioneer Kai-Fu Lee to discuss his venture capital portfolio and deep tech investment opportunities. We also cross over to Lugano, Switzerland, where there's a Ukraine recovery conference. Our Maria Tadeo is on the ground, so we'll of course have plenty more from Lugano. NATO's there. We heard there from, well, we saw briefly the Secretary General. So we'll economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Kai-Fu Lee, the celebrated AI pioneer, is a China expert and, of course, venture capitalist. Following a string of executive positions at Google, Apple, and Microsoft, Lee went on to found his own company, Sinovation Ventures. Now, it's a VC firm focused on developing the next generation of Chinese high-growth tech companies, and his best-selling books, AI Superpowers and AI 2041, predict how AI will transform the economic and social order. Well, Kai-Fu Lee joins us now. Kai-Fu, first of all, thank you so much, because I know you give us a lot of time, and I always enjoy our conversations. How is AI going to transform, actually, the way we read data and we look at the economy, given the fact that, actually, over the last 2 years, we had no idea what's going on? Economists got this wrong.
Well, I think AI can analyze a lot of data. As long as you have a huge amount of data, AI is very good at helping us to analyze, predict, classify, and make decisions even. So, for example, we have developed a trading algorithm based on AI that buys and sells stocks, and it performs better than people.
Yeah, I'm sure. I mean, can you read inflation? Because that's the big thing that everybody wants to know about. I mean, are we going to see actually AI transform also the world of economics?
I think that it's a little bit harder now that we have these black swan events. AI is basically built by using historical data that represents well what the future looks like. And the definition of a black swan event, for example, in the last 2 years, we saw something that's never happened before. One is an innovation bubble, where people anticipated tech to go up like this, and then because of COVID, and then they came down. We never saw that before. And then the trillions of dollars issued by governments, particularly the US, again, never saw that before. So AI cannot predict things that just happen one time ever.
What are you working on right now? I mean, I know there's, Sinovation basically has a lot of themes that you want to solve. Yeah. And again, what's the difference between a US, the way they use data, and what they're working on, and some of the Chinese companies?
I think the two countries tend to work on what they do best. I think American companies are best at building enterprise software and doing AI on top of that. I think a lot of companies like C3 AI, Palantir are going in that direction. In China, a lot of our investments are with China's strength, that is manufacturing. So we're looking for ways to automate the factory, the warehouse, moving things automatically with robots, making things with robotics and arms, and also even taking these kind of technologies to replace the human-run wet lab, which is, COVID tests, PCR tests, and also tests and experiments and scientific work done by professors and researchers can now be done better, faster, 24/7 by robots. So I think the robotic revolution is one that I think China is particularly strong, because China is already the factory of the world.
But this is just the beginning. So how much more, in 5-10 years, where will we be in terms of job displacements?
Yeah, I think a lot of jobs, of major jobs, for example, drivers, right? I think autonomous vehicles are actually making very good progress. So that's a category of jobs that's quite a few percentage points. And the same will happen in blue collar, as I mentioned, as robotics takes over in the assembly line. But similarly in the US, as smart software is able to streamline processes, that means companies will not need repetitive, routine workers who do copy and paste and who are at entry level, whether it's accounting or entry level legal, entry level human resources. There will be a significant number of job tasks that will be done by AI, leaving fewer jobs in current categories. There will be new jobs emerging, but those will be more skilled jobs, and it's not clear that we currently, what any country in the world, has enough training program in place to help those whose jobs are replaced, displaced by AI, to find the right training.
Right, Kai-Fu, will robots, powered by AI, ever have feelings? And do business need robots with feelings?
I think there are many business opportunities if robots could have feelings, but currently they certainly don't feel any feelings, but it doesn't mean they can't fake it. So, a lot of chatbots on the internet are, I think, causing people to be addicted in talking to them, currently by text, in the future by speech. There will be virtual robots that look like they could be your friends. They'll be put into, training, learning applications, games. I think we're going to see more and more of that related to the metaverse. About a walking robot that actually comes to our life that's indistinguishable from human, I think that we're at least 25 years away, if ever, to do that.
Where do you see the metaverse? So where do you see opportunities in the metaverse? Again, a lot of the big brands are looking at the metaverse, but then you have economists that say, look, this is feasible maybe in 5-10 years. It'll take a long time.
I'm with the latter camp. I think metaverse is a big deal because we definitely want a world inside an immersive environment that's as real as the real world, and maybe even a digital twin of that. And also games and entertainment, I think, will take off. But just the fundamental technologies with sensors, displays, and quality content, it's not something we can have overnight. So 5 to 10 years seems like a reasonable projection. In my book, AI 2041, it's one of the stories that I think will change the future of entertainment in a 20-year time frame.
Which is a great book, so I urge everyone to read it. It's nice and concise and not too long. Kailey, talk to me a little bit about some of what we've seen in the market. So we saw this technology rout. Is this healthy correction? Or do you think investors are not kind of making a difference between technology companies?
I think the correction is a result of a number of technology companies, primarily American ones, but also Chinese and others, that people made a too optimistic a projection because of the onset of COVID caused us to move to technology such as remote work and things like that. But then now that COVID is more or less over, at least from a work standpoint, the growth rates have gone back to the old levels. And that was disappointing to people because they expected a shoot up, but now it's coming down. So I think it is a one-time correction that I think technology is still at the center. I think it's not growing as fast as some people had hoped, but I'm not sure it's over because there's...
What's the piece of technology you're most excited about?
I'm extremely excited about AI, robotics, but also life sciences. I think synthetic biology, gives us the ability to create and edit life. And I think medical discoveries, drug discoveries using AI is very exciting. And I also think new energy. We have not only green energy to look forward to, but much lower cost energy using hydrogen and other solutions.
Kai-Fu, as always, thank you so much for coming on. Kai-Fu Lee there, of course, the chairman and CEO of Sinovation Ventures and really one of the fathers of AI, who understands it most than anyone, certainly, that we speak to. Now, this is a picture for markets. U.S. futures taking a downturn. They've just turned negative, falling some 0.1%. Nothing huge, but something to keep an eye on. We also saw similar moves on European stocks. Now, coming up, we'll have plenty more on inflation. Also, German gas giant Uniper in talks with Germany on a possible €9 billion bailout package. More on that next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. President Joe Biden may announce as soon as this week a rollback of some U.S. tariffs on Chinese consumer goods, but a new inquiry into industrial subsidies could lead to more duties in strategic areas, including technology. Our sources say Biden has not yet made a final decision, and that timing could slip. A move would mark his first major policy step on trade ties between the world's two biggest economic powers. Now, Ukraine says it needs $60 to $65 billion this year to meet its funding requirements. The amount excludes defense spending and is part of a larger blueprint for reconstruction, which is estimated to exceed $750 billion. The recovery plan, which was unveiled on Monday, includes 3 stages extending over the next decade, starting with rebuilding critical infrastructure this year. In an exclusive interview with Bloomberg, OECD Secretary General Mateusz Korman says Russia should contribute to Ukraine's reconstruction.
Russia should absolutely contribute, and I think that there is a broad consensus that given, the circumstances of this war of aggression and what has caused, this devastation, of course there ought to be, as part of the overall financing effort, also that there ought to be also reparation from Russia, in the appropriate way.
Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thanks so much. Coming up, rebuilding Ukraine. Don't miss our exclusive interview with Bjerde, the VP of Europe and Central Asia for the World Bank. This is Bloomberg. Trade truce. The U.S. could roll back some China tariffs as soon as this week to counter rising prices. Beleaguered German gas giant Uniper is said to be negotiating a government bailout worth up to 9 billion euros. Shares sink as the company negotiates. And 50-50, the RBA delivers back-to-back 50 basis point hikes for the first time ever and does not rule out further tightening to slam the brakes on inflation. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, let's check on the euro. Euro falling to the lowest since 2003 against the dollar. The euro actually also is a sign of dollar strength. So we have on our live blog, Lorcan Rosh Kelly, one of the most smart currency analysts. And they say, look, if you look at U.S. dollar, it may be positive smoke signals on U.S.-China trade. Maybe it's increasing global fears of a recession. Whatever it's causing it, the dollar is getting a bid this morning. So we do have also other currency moves. For example, dollar, one of the major macro factors of the year so far. There's nothing to suggest that we're going to see a reversal of this trend anytime soon. So watch out for that. And then the Hungarian forint having a particularly bad morning, dropping more than 1% against the dollar, hitting an all-time low against the euro. If you look at, the talk surrounding euro-dollar parity in the following weeks has been a closely debated one. Again, if you look at what the pressures on both sides is, I guess we also need to look at euro-yen to see whether it's more of a dollar story and dollar strength or actually euro weakness. Now let's get straight to your Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Scandinavian airline SAS has filed for Chapter 11 to tackle its debt burden for a second time in 2 years. The airline's chairman says the move is the best way to reach its objectives. Scandinavia's largest airline has been in talks with its creditors to convert 20 billion Swedish krona, that's about $1.9 billion of outstanding debt and hybrid notes, into shares. The development comes a day after SAS Pilots Union announced they would start striking with immediate effect. Bloomberg has learned a group led by KKR is a front-runner for the stake in Deutsche Telekom's wireless tower unit. Sources say KKR's package is more attractive than rival Brookfield Asset Management's proposal. Deutsche Telekom is expected to make a decision this week. The unit may be valued at about $20 billion in any deal. Now, Japanese chemical supplier Showa Denka says it's expecting to further raise prices and cut back unprofitable product lines. The Tokyo-based company supplies chip fabrication materials to the likes of TSMC. It's already raised prices at least a dozen times this year due to supply chain snarls, surging energy costs, and the yen's dramatic weakening. Bloomberg's been told Airbus delivered about 55 jets in June, leaving it only 2/5 of the way towards its full-year goal. Our sources say Airbus has handed over fewer than 300 planes this year against a 12-month target of 720. Supply chain issues and raw material shortages are holding back deliveries, even as it seeks to lift production. And that's your Bloomberg Business Flash. Francine.
Thank you so much, of course, our very own Leanne Gerrans. Now, world leaders gathering in the Swiss town of Lugano for a second day to map out a plan to rebuild Ukraine. The country's prime minister has suggested that could cost $750 billion. Well, let's get straight to Bloomberg's Maria Tadeo, who's at the conference and has a guest with her. Hi, Maria.
Yes, Francine, and we've been here in Lugano now for 2 days. Of course, a very high-profile Ukrainian delegation is in a fundraiser to try to repair some of the damage done to this country as a result of the war. And joining us here from Lugano is Bjerde, of course, you're Vice President of the World Bank. You know the region very well. And I asked you this off camera. There's a lot of perhaps criticism that a conference like this won't really achieve anything because you're putting a number on a hypothetical. The war is still ongoing, but you told me it's very important to be here. Why?
Yes, absolutely. It's important to be here, even though, of course, the war is still very much ongoing. And we need to actually, I want to make the first point, we need to support Ukraine during the war. World Bank experience shows that countries in conflict need to be supported, because if you wait until the war ends, you will actually have a much harder job to do to reconstruct rather than supporting the government throughout. So what is helpful with being here is that we're coming together in a very large setting, many participants, to talk about the enormous needs of Ukraine. And these needs, yes, we're starting to see some numbers, but I do want to emphasize these numbers will keep being updated because we will need to keep taking new information into account. But already we know that there are critical infrastructures, housing, roads, bridges, education facilities that need to be repaired. And we cannot wait by starting to have those discussions because it will take enormous amounts of money, coordination, collaboration to be able to get started.
And you mentioned the numbers. Some of the numbers, and I was paying attention to the debate yesterday with the Ukrainian Prime Minister, the numbers are huge. I mean, they say on the short term is $100 billion, just the short term. The overall package can go to $750 billion. In your assessment and everything that you know about the region and the country, how much damage has been inflicted, but also how much help does Ukraine need?
So we very much are in line with the $100 billion. We're doing right now with partners a damage and needs assessment for Ukraine. We have some preliminary data. It will come out in August. We're also putting the key sector direct physical damage to Ukraine is around $100 billion.
That's infrastructure, trains, railroads, all of it.
Exactly. It's housing takes the single largest block of it, but it's also critical roads, bridges, water supply, energy, and also education facilities, hospitals. This is where we need to get started. And we know that it's very important to put the direct physical infrastructure price tag on first, if you will, but the numbers that are being quoted, including by the Prime Minister, is of course the whole cost to the economy is enormous, because Ukraine's, when we have done the analysis, GDP is going to contract by, we believe, 45%. This 45%. Is huge. Yes, it's huge.
And actually, that's a perfect segue to my next question, because that's for the long-term picture, but the short-term funding for this country that's burning cash on a monthly basis to keep the war effort going. The IMF say they probably need $35 billion this year. There's a gap there before potentially they enter a dangerous phase in which they may not be able to pay for some of these basic needs. Who's going to prop up the short-term funding for this country?
So I have to say development partners have come together to raise a significant amount of funding to provide exactly where I started, support during the conflict, to keep government services, critical social expenditures going. And I want to emphasize here, we, together with the IMF, are looking at about a $5 billion need every month. So if you take it up until the end of the year, yes, you arrive at about 35 billion. And the World Bank in and of itself has now a project whereby we are funding critical services for Ukraine, and we are mobilizing international donor funding through that. So just to put some of the numbers into context, we, the World Bank, since the war started, have actually committed our own funding and mobilized $6.7 billion to Ukraine, and we have dispersed no less than $4.5 billion of our own money and mobilized money. And this is very important because it's going to the Ukrainian government to be able to meet these expenditures, such as government wages, teacher salaries, social protection, support to internally displaced, pension payments, and so on.
And can I ask you, I don't want to speculate too much about this because I know it's very delicate, but there has been reporting that Ukraine is looking potentially at some restructuring. Of course, the fear is to get to a point where you're not able to pay, so that's another technical default for the country. Can they weather the storm and avoid that? I guess that's a responsibility of partners here, so that they don't fall into that debt trap.
Yes, so of course, debt, but even before the war, debt management is something Ukraine had to manage and actually is doing quite ably. Debt is one of the key obligations that's on the expenditure side of the budget and will need to be addressed as Ukraine goes through this process of very carefully and very with great difficulty.
For that?
Well, I get a sense that there's a recognition that there are obligations Ukraine has to meet, and they have to think through different options of doing so. From the World Bank point of view, we're really focused on making sure the social expenditures can be paid, and that's why we have created this mechanism, this project for that.
And can I just ask you as a final question? Yesterday, when I listened to the Ukrainian Prime Minister, he kept going and repeating this thing of Russia has to pay one way or another. There's got to be Russian reparations. Of course, Vladimir Putin is not going to pay directly a cent to this, but there's a talk about what do you do with everything that's been confiscated from Russian assets. Would you be in favor that this option gets explored?
So I won't comment on that, but I will say this. Rebuilding and reconstructing Ukraine, given the enormous amounts that will be needed, will take a huge effort of public resources and the private sector. And I really feel coming out of this conference, we are getting this great sense that this is going to have to be a huge public-private partnership. There's Ukrainian private sector, there's international private sector, there's a lot of interest in being part of the rebuilding and reconstruction of Ukraine. And I really look forward to seeing how we as the World Bank can help provide incentives, enabling environment to get the private sector in.
Well, thank you so much for that. Anna Bjerde, of course, Vice President of the World Bank. And Francine, the Russian reparations, this is still a conversation. Of course, there's a lot of questions about the legality of it, but the Ukrainians are not letting this one go. They still say, look into it because it's the right thing to do after the war is done. We'll have to wait and see whether that materializes or not.
Maria, thanks so much. Maria Tadeo there with Anna Bjerde, the VP at the World Bank. Now, it's extremely interesting, of course, to see that the amount that Ukraine had asked this gathering in Lugano, I think they were saying they have an estimated $750 billion to rebuild the war-shattered country. Again, for the moment, there's a lot of support from European countries saying there is no limit. As you see the inflation costs rise, as you see the cost of living costs rise, you wonder whether there is a turning point where actually some of the countries will back down in terms of funding. It's a question we need to ask ourselves. Coming up, natural gas now rivals oil as a fuel that shapes geopolitics as soaring prices for the commodity pushes Europe to the brink of recession. That's today's Bloomberg Big Take. That's coming up next, and this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, last March, the BOE had warned that Russia's invasion of Ukraine has increased economic uncertainty and led to exceptionally high commodity market volatility. That prompted it to delay the launch of its 2022 stress tests for UK lenders. Now, it's due to be released or to release its financial stability report this morning at 10:30 a.m. UK time. And the central bank said that while the UK's direct exposure to Russia was limited, the war may actually pose further risks to the UK financial system. Well, joining us now is Bloomberg's economics and governments correspondent Lizzie Burden. So, Lizzie, thank you so much for joining us. Look, they've delayed the stress test, but are we expecting actually anything ugly to come out of it?
Well, we may get a postponement or a complete cancellation of the stress test. We might get a timetable for them. But really, the sense I'm getting from the Bank of England is if they delay the stress tests, it would be less about showing leniency to lenders in the cost of living crisis and more about it being not so worried, actually, about the resilience of the banking sector. And the reason I say that is because back in December, the 8 biggest banks passed the stress tests, and the conclusion of the report was that they could weather a double-dip recession if one came. And even since then, we've seen the Bank of England saying that none of the banks would likely need a public bailout in the event of a crisis.
What about crypto regulation?
Yeah, crypto was a key theme in the last report, but of course that was before the war in Ukraine, which is probably going to dominate this time. Investors are going to be looking out for signs of whether there'll be tough regulation on crypto and where that regulatory perimeter will lie. Deputy BOE Governor John Cunliffe has been one of the voices calling for tougher regulation. But the crucial point is, even if the crypto market is tiny compared to the global financial system, it's now bigger than the subprime mortgage market was at the time of the financial crisis. And it's not just the current size, it's the rate of growth. That's what Cunliffe says poses the risk to financial stability.
Lizzie, thank you so much. So the report's out in 45 minutes, right? 10:30.
10:30.
45 minutes, and then we'll know what exactly is in this financial stability report. Lizzie Burden there. Now let's get straight to Europe, and gas shortages rippling through the global economy, threatening recessions and a further wave of inflation. That's the subject of today's Big Take. And the commodity has soared 700%. Just think about it, 700% in Europe since the start of last year, becoming the driving force in the new Cold War. Now, for more, we're joined by our Bloomberg energy reporter, Stephen Stepczynski. First of all, Stephen, it's much more difficult. So gas, a fairly boring commodity up until, I guess, 2 years ago, is now like the hot topic because it's also much more difficult to replace gas stockpiles than oil stockpiles, or it's more difficult to get gas in if Russia turns off the taps.
Absolutely. I mean, to give you a little bit of context, I've been covering natural gas for a decade, and there's not as much interest now as there was, now there is much more interest than there was a decade ago. And that's because the world's become much more dependent on natural gas. They become much more dependent on cheap Russian natural gas. And that's why natural gas has become this geopolitical tool in a lot of ways, because the world needs it. And if Russia were to cut off supplies, like they're curbing supplies via the Nord Stream pipeline right now, you see an immediate impact on industries, you see an immediate impact on economies, and Germany is warning that it could have a Lehman shock sort of situation if they were to totally cut off all gas supplies, because there just isn't enough globally to fill the gap left by Russia.
So, Stephen, how is winter looking for the global natural gas market?
It's not looking that good at the moment. The inventories aren't being filled fast enough with the little bit that they're getting right now from Russia, and there isn't enough liquefied natural gas, that's how you ship it via sea, in the market to help refill European inventories. So what's going to happen is Europe is likely going to be entering winter with lower inventories that they were hoping to get. They wanted to refill by 90% before winter strikes, and winter is when demand for natural gas, which is a heating and power plant fuel, that's when it spikes. Now, there is a chance that if they can't fill to a certain level, that there will be gas rationing this winter on top of record high prices for gas. That means that industries might not be able to get gas. They'll have to shut down. That means really high prices for gas for households. If you wanted to heat your house, it's not going to be cheap.
So, Stephen, give me a sense of, how difficult is it to, replace gas? Is there something that we could do to make up for it?
There are two things. One, you find alternative fuels. So in the immediate term, you go to coal, you go to diesel. Another thing that, for example, Japan, the world's second biggest LNG importer, what they're doing is they're pushing their citizens and businesses to just consume less. If you reduce your demand, there isn't as much need for natural gas, and there's less gas you need to replace. In the long term, there will be investment in more facilities and more supply. The United States, there have already been 2 U.S. LNG export projects that have been sanctioned this year. There are probably going to be more going forward. Canada, too. And Qatar is moving forward with a giant expansion. But you can't get that supply online by winter. You get it online by 2026, 2027. So in the immediate term, the best solution is just don't use gas.
Okay, there you go. Put an extra jumper. That's what the Brits do. Stephen Stepczynski there from Bloomberg joining us today. And you can, of course, read today's Big Take, typing NI Big Take Go on the Bloomberg terminal. Now, coming up, U.S. President Joe Biden is close to announcing a rollback of Trump-era tariffs on Chinese goods. We'll have plenty more on that story next. And this is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, U.S. President Joe Biden is close to announcing a rollback of Trump-era tariffs on Chinese goods. Sources say he may make the decision as soon as this week. Well, Bloomberg's chief Asia economics correspondent, Enda Kern, has been following the developments. Enda, good morning, good afternoon again. What is the significance of these talks?
It does feel like there's momentum behind this now, Francine. We had a call today between top Chinese and U.S. officials on the topic of tariffs and sanctions. The readout from both sides said there was also some discussion around areas of cooperation and global supply chains. But this call was the first since October between the Vice Premier and the Treasury Secretary of the US, and it does lend its way to this idea that there might be something coming down the pipe. Now, our Washington colleagues are saying that the administration there is looking at bringing down tariffs. We don't know specifically what products they will target, be they industrial or consumer, how much they will bring those tariffs down and how quickly. But I would say, though, that economists' reactions today was fairly subdued. Most people are saying even if they were to bring down all the tariffs, it would have a fairly muted impact on the overall inflation story, given the gravity of the price pressures in the US at the moment.
So, and if this is not a game changer for inflation and markets are taking it well, is it because there's hope that actually two countries will be closer? Does it have an impact on, for example, how they deal with Russia, or what's the thinking behind markets right now?
Indeed, Francine. I mean, on a headline basis, you would say, look at this, the US and China are talking again. There are expectations. We've reported there might be a call between Presidents Biden and Xi over coming months. And as I say, it's the first call since October between these economic officials. So all of that lends itself to some kind of positive energy, but it's fairly incremental. And in truth, none of this really changes the bigger picture. The US is clearly having to respond to tariffs because of its inflation story. It doesn't change the broader competitive or strategic rivalry between both governments now. It won't change the tensions over human rights, Xinjiang, Taiwan, Hong Kong. Of course, it won't change the attitudes over economic competition between both sides either. I think if this does happen, if it does come true, it will be incremental at best.
So does it change the dynamics with supply chains, or is it because that's completely to do with COVID-0 policy, even that won't change at the margins?
Well, it was interesting. This was part of the discussion. Janet Yellen and their readout, they were saying, look, it's in both sides' interest to have stable global supply chains. Not really clear what the US can do about it. China's supply chains are pretty much getting up and running again after that big Shanghai lockdown. But of course, there's still lots of complications in the system. I would say one of the other talking points from the call this morning was the fact that Janet Yellen raised the spillover from Russia's invasion of Ukraine. Of course, that goes to the core of tensions with China, with many countries around the world right now. So as I say, even though they're talking about potentially bringing down tariffs, they're also clearly raising the very difficult topics between them as well.
Thank you so much. So Bloomberg's chief Asia economics correspondent, Enda Curran, there in Hong Kong. Now, we also look at the markets, and actually there is quite a lot going on in currency markets. So when you look at euro dollar, as dollar strengthening, euro weakening, there's been so much talk about parity, and we're now at 1.0311. That it does seem like we could get to parity, which would be a huge game changer, not only psychology, but of course some of the earnings conundrum for some of the companies. Now, it is a positive smoke signal, maybe on U.S.-China trade, that we're seeing euro dollar trading where it is. It could also be an increasing global fear of a recession. Whatever it's causing it, the dollar is definitely getting a bid this morning. Now, we've been calling around, of course, some of the trading floors. If you remember, dollar strength been one of the major macro factors of the year so far. There's nothing to suggest, according to Lork and Rosh Kelly, that we're seeing or that we're going to see a reversal in this trend anytime soon. Bloomberg Surveillance Early Edition continues in the next hour. Well, Matt Miller, Katie Greifeld in New York, or Danny Berger's here in London, and this is Bloomberg.
We do think the second half of the year will be much better than the first.
The next 6 weeks, in my opinion, it's going to be the news headline battle is going to be between earnings and inflation.
Overall, we're looking at an economy losing momentum faster than what we anticipated.
We've been looking for not necessarily a technical recession, but a significant enough slowdown into next year.
I think the risks of a 2022 recession are significantly higher.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
Good morning. It is 10 a.m. in London, 5 a.m. here in New York, and 5 p.m. in Hong Kong. Welcome to Bloomberg Surveillance Early Edition. I'm Matt Miller with Katie Greifeld here in New York. Danny Berger is with us in London. Anna Edwards is off, as well as Kailey Leinz. Here are our top stories today. President Biden may be on the verge of rolling back some of the Trump-era tariffs on Chinese goods. Senior officials from the U.S. and China discussed the matter in their first talks since last fall. Ukraine will unveil a massive rebuilding plan this week. It may take hundreds of billions of dollars to recover from an invasion that has destroyed cities and shredded the economy. And the euro sinking to a 20-year low against the U.S. dollar. Investors paring bets on ECB interest rate hikes, given the growing risk of a recession in the region. So, Katie, there's a lot going on today, including what I also find fascinating, conflicting oil calls. We're hearing from Citi that it could go as low as 65. JP Morgan says it could go as high as 380.
Yeah, some conflicting signals in the oil market and in risk appetite in general, because it started as what I would say a tentatively risk-on session in Asian trading, thanks to that news that the Biden administration reportedly close to rolling back tariffs on Chinese goods. That boosted the MSCI Asia Pacific Index by about 0.5% at one point. Those gains fading, though. Same thing for the Hang Seng Index, started solidly higher, but that rally fading up about 0.1%. In Australia, though, you had the Reserve Bank of Australia hike rates by 0.5%. That is the biggest rate hike ever for Australia's central bank. But if you look at government bond yields, the 3-year yield up just 1 basis point, with investors maybe wondering if we're at peak hawkishness. And of course, we are seeing dollar strength across the board against the euro and against the yen as well. The dollar yen up about 0.1% or so, Danny.
Yeah, Katie, it is that euro story that is dominating Europe. When markets opened, it opened to the upside, looked a lot with like what you were seeing in Asia, but that turned within the last hour. Now stocks widely negative across the board. UK, French stocks, those are the ones out underperforming, down more than 1%. We also had a revision to French PMIs to the downside. All of that underscoring the economic fear very present throughout Europe. Perhaps one bright spot in this equity market is Uniper today. This is, of course, the gas giant in Germany, really struggling considering that Russia has been shutting off flows through Uniper through to the rest of Europe. Now, according to people familiar, telling Bloomberg that the German government is looking at a rescue bailout of about 9 billion euros. So that's moving higher, but everything else, again, really negative today. Euro dollar 103.05. That is the lowest level since December 2002. The momentum is to the downside, falling more than 1%. Is it 102 next? Is it parity next as well? One thing that we're seeing really leading this is a repricing in this bond market. We're now looking at about 140 basis points priced in for rate hikes from the ECB this year. That's moving down from about 190. German 2-year yields giving up basically everything they put on yesterday. It was higher by about 10 basis points today. Matt, now German 2-year yields falling by about 12 basis points. That rate differential story with the U.S. really coming into the fore again, playing out through currency volatility.
Yeah, and we're seeing real dollar strength across the board today. Danny, take a look at what's going on here in the U.S. Futures down by about 0.5%. So if you thought that U.S.-China talk story was positive for risk assets, well, the market may be reading that a little bit differently, or worried more about a deep recession. Are we already in a recession? Here, a lot of analysts say yes. The U.S. 10-year yield coming up a little bit, but at 288.21, so still well below that 3% level. NYMEX crude also gaining a little bit, which is interesting. If risk assets are down on recession fears, you'd expect crude to drop as well. Again, we have competing oil calls. Citi saying 65 because the recession could be deeper than the market is expecting. JP Morgan says it could go as high as 380 because Russia could just say, you know what, we're taking 5 million barrels off the table here. Bitcoin rising just about 0.3%, so not any kind of move from midnight right now at 19,814, but we had seen it retake the $20,000 level just to fall a little bit back below that. Katie?
Yeah, that $20,000, definitely a white whale when it comes to Bitcoin. But in any case, let's look at what's ahead for today. We're going to hear from Bank of England Governor Andrew Bailey. He briefs the press on the central bank's financial stability report at 6 a.m. New York time. It's also day 2 of the Ukraine Recovery Conference in Lugano, Switzerland. And we'll get some U.S. data, including factory orders and durable goods orders. Matt.
All right, we'll be watching those. I think factory orders will be especially exciting today to see what the inflation picture is going to play out. You know, a lot of people are talking about the fact that there are inventory buildups from Walmart to Target, but certainly not at the gas station or on dealer lots. Now, President Biden is close to announcing a rollback of Trump-era tariffs on Chinese goods. This clearly the top story for markets today. Bloomberg has learned that he may make the decision as soon as this week. Joe Matthew, Bloomberg Washington correspondent, joins us now from Washington, D.C. with more. So, Joe, what do we know?
A little more urgency behind this whole story, Matt. It's something we've been talking about for a couple of weeks, but it does appear that the president could be close to making a decision as we learn about a high-level meeting between the Treasury Secretary Janet Yellen and China's vice premier. They spoke about this by video conference, and the U.S. readout was positive. They called it candid and substantive, but I have to tell you, Matt, there's quite a bit of skepticism, as we've seen with a number of steps that the administration has taken in the effort to lower inflation here. Analysts from the Peterson Institute for International Economics estimate that removing the tariffs would lower consumer prices here in the United States by about 0.2%, maybe a quarter percentage point. That could rise, they say, to 1 percentage point if U.S. companies react by marking down their goods here. So it could have a muted impact, and the administration has to balance this with the potential loss of leverage that America would have over Beijing here. One thing that we are hearing is that this may not just be across the board. We're talking about consumer goods, Matt, where he would be cutting tariffs while also increasing tariffs potentially on things like transportation equipment and industrial equipment here. So we'll be watching this closely for a couple of days. There may be a way that the White House can slice this down the middle.
And Joe, when it comes to the China competes legislation and that semiconductor funding bill, what's the latest? What do we know?
Boy, you know, look, this has been bogged down for the better part of a year. It's something that was said to be bipartisan. It's been in a conference committee now for a couple of months with 100 conferees trying to hammer out the differences between a House and Senate version. This is something that was supposed to be an easy layup, essentially, for Democrats and Republicans. But the negotiations have been stalled, and now Mitch McConnell, the minority leader in the Senate, says he will not support this. It won't be a bipartisan vote if Democrats continue this idea of pursuing a reconciliation bill to hike taxes and lower drug costs. That's another kind of a conversation that's been going under the surface here for weeks and months. So this could be in jeopardy right now. It's something that the administration says the United States must have to get more domestic manufacturing of computer chips, and it's just not looking very good at the moment here.
Joe, thank you very much. Bloomberg's Joe Matthew there. And you can get more great content from Joe every weekday on his radio program, Sound On. That's 5 p.m. Eastern Time on Bloomberg Radio. Ukraine's government has indicated it needs up to $65 billion this year to meet its funding requirements. That's billions more than its allies have pledged so far. Bloomberg's Maria Tadeo spoke with the OECD General Secretary at the Ukraine Recovery Conference in Lugano, Switzerland yesterday.
Russia should absolutely contribute, and I think that there is a broad consensus that given, the circumstances of this war of aggression and what has caused, this devastation, of course there ought to be, as part of the overall financing effort, also that there ought to be also reparation from Russia, in the appropriate way.
Let's get straight to Maria Tadeo, who joins us now from Lugano, Switzerland. Maria, it does sound like there's a lot of focus there with how to make Russia pay for the cost of reconstruction. What do those conversations sound like?
Yeah, Danny, because someone's going to have to pay for this. And the numbers in this conference now, for 2 days, a high-profile Ukrainian delegation has been meeting with international partners, also European institutions. And the idea here is to prop up money for this economy, which has been destroyed as a result of the Russian war. Now, the numbers floated around are incredible. They're enormous. Potentially, this is the biggest effort since the Marshall Plan. We're looking at $100 billion potentially just in the short term. And then that can go all the way to 500, 600, even 700. Now, the question is, who is going to pay for this? We've heard from the United States. We've also heard from international institutions, the European Union too. But the Ukrainians also say, and they repeat, they're not letting this one go. Russia should pay reparations. Vladimir Putin is not going to pay a cent directly to this country, but he could potentially, international countries, a G7 jurisdiction, agree to use some of the central bank reserves that have been seized, some of the private property too, and release them to the Ukraine Ukrainians after the war is done. Now, this is a conversation that legally it is very tricky, but I am surprised by the number of officials that behind the scenes here told me this is perhaps something that we should explore in the future.
And Maria, with the conference wrapping up, what concrete steps forward can we expect?
Look, I think that we're about to find out. There's a declaration which they say will be called the Lugano Declaration and will set out the basis for the reconstruction effort. But to me, and this is the issue, this is a conference that at times feels very bipolar because we're talking about a hypothetical here, the peace process for Ukraine. But what we know is that the fight on the east is still incredibly active. A lot of these figures, of course, they change all the time according to the needs of Ukrainians. But I think for a lot of officials, they still feel that being here today is very important because A, they want to coordinate this Marshall Plan. They want to divide some of the tasks, but also they say it's important and incredibly, pressing issue to identify the key areas to invest. A lot of them say it will have to be about infrastructural, the railroads, all of this, because if you want the Ukrainians to export grain, you have to make sure their basic infrastructure is operational and works.
All right, Maria, thanks very much. Maria Tadeo there reporting from Lugano in Switzerland. Now, the euro sinking to a 20-year low against the U.S. dollar. Ven Ram of Bloomberg Markets Live joins us now for more on what's driving the move. Van, I noticed Germany had its first monthly trade deficit since 1991. That's a real sign of pain for the European economic machine.
Morning, Matt. Yes, indeed, that is a big concern. And those concerns are manifesting in the overnight index swap markets, where investors who were previously betting that, we are going to get 180 basis points of tightening from the ECB by year end are now saying, oh, maybe not, maybe we'll just get about 140 basis points. And that is having a big ripple effect on the currency markets. And we have seen the euro on the back foot. And that may continue to be the case if the markets pare back more and more of the rate hikes priced in. And if it's a tug of war between the economy, strength in the economy, and how much of the ECB will go to contain rates. And if that tug of war is won by the economic side, meaning the markets pare back the rate, but the euro has more to drop.
All right, thanks to Ven Ram of Bloomberg M Live. Definitely a big day of dollar strength, and it's only about 5:10 a.m., at least in the U.S. Now let's take a look at some of the stocks that are moving in pre-market trading in the U.S. I do want to start with Carnival because it had an absolutely brutal week last week. Remember, there was that big downgrade from Morgan Stanley. The bank's base case for Carnival is $0 per share. We're not quite there yet, but you do have Carnival trading a little bit higher. It is lower in pre-market trading, though. And I do want to also highlight Occidental because we had some late news on Friday that Berkshire Hathaway has boosted its stakes in Occidental Petroleum. Traders seem to like that vote of confidence. Occidental Petroleum higher by 2.7%. And like Matt mentioned earlier, you do have Bitcoin slightly higher. That means Coinbase is higher as well. But remember, we got that huge downgrade from Goldman Sachs last week. Definitely the bloom coming off the rose when it comes to Coinbase. We'll see if it hangs on to those gains, Danny.
Always nice to see some individual stocks able to fight against that downdraft of the macro forces. And that's exactly what we'll talk about coming up. We're going to be speaking with Skylar Montgomery Koning, Senior Global Macro Strategist at TS Lombard. Does she think yields have further to go? And soaring natural gas prices pushing Europe to the brink of recession. That's our big take. More on that story ahead. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Katie Greifeld in New York and Danny Berger in London. Anna Edwards and Kailey Leinz are off today. Now, one of my producers in London, Dan Curtis, made this brilliant chart. For those of you listening on radio, I'll tell you what it shows us. The percentage of S&P 500 companies that are beating earnings expectations is dropping drastically. At the same time, analysts are sticking with incredibly high earnings estimates. Why? Joining us now is Ksenia Galuchko, Bloomberg Equities editor. Ksenia, is this setting us up for an earnings season of pain?
Yeah, this earnings season is going to be a big surprise and a big game changer for stocks. So just today, Morgan Stanley's Michael Wilson has come out with a note saying that until the earnings expectations come down from the highs that we're seeing them at right now, this bear market in stocks is not over. And Goldman Sachs just yesterday, Goldman Sachs strategists also said that earnings expectations are just way too high at the moment.
How much is that playing into the sectors that are outperforming or underperforming this year?
So in terms of sectors, there's a very clear divergence. So most sectors are seeing a slowdown in earnings expectations, and there's a big exception to that. It's the commodities sectors. So energy and material sectors, miners, are seeing huge growth in earnings expectations because of the boom in commodities. Now, those earnings might come under pressure because we've been seeing a drop in oil and metals prices since the peak in June. So it'll be a very interesting earnings season because even the stronger sectors like commodities might face some headwinds and pressures.
And Ksenia, before we get to earnings season, I want to talk a little bit about what's going on in bonds, because last week when we saw that enormous bid into treasuries, the explanation I got over here was that basically you have investors worried about growth rather than inflation, sort of replacing what the top fear was. Is that the case in Europe as well?
Yeah, that's the troubling thing about the drop in bond yields, right? Usually that would mean good things for the market, for the equities, because usually it would mean that, the equity markets are becoming more attractive, but not in this case. It's the recession fears that are driving the move in bonds and treasuries and also the bonds in Europe, right? So the recession expectations, the fears of a slowdown are really, really spreading across the market, across asset classes. And at this point, it means risk off across most asset classes in this case.
And got to just wrap it up here with the euro. I mean, some pretty massive moves, lowest since 2002. When you look at the cross-sector implications of such pain in the euro, what do you expect to see?
Well, that's the thing. So usually a weaker euro would mean really good things for European equities, right? Because exporters would benefit greatly from the weakness in the currency, but not this time around, unfortunately, because the euro is dropping mainly on recession fears, mainly on concerns about a more hawkish turn in the ECB's policy, the general slowdown in the economy, these contraction fears, they're driving the weakness, and that's why it's not good news for European equities, which usually had, very opposite correlation with the euro in the past.
Yeah, it probably doesn't help that it's also just summertime. Liquidity is bad, not just for the euro, but stocks as well. Ksenia, thanks so much. As always, Ksenia Galuchko from our Bloomberg Markets team. And for more market analysis, MLive Go is where you want to head on your terminal. This is Bloomberg.
Now, keeping you up to date with news from around the world, here's the first word. In Highland Park, Illinois, a 22-year-old man is being held in connection with the killing of 6 people at a 4th of July parade. Dozens of others were wounded. The man was arrested after a brief chase. Police believed the attacker opened fire from the rooftop of a building near the parade route. The new leader of Hong Kong is signaling a cautious approach toward the coronavirus. John Lee says the city must balance travel inconvenience with limiting the spread of COVID. He also warned that people in Hong Kong should only be allowed to go about their normal activities once it's certain they're not affected. And Bloomberg has learned that a consortium led by KKR is emerging as the frontrunner to buy a stake in Deutsche Telekom's wireless tower portfolio. The business could be valued at around $28 billion in any deal. Deutsche Telekom could pick a winner this week. Citigroup warns that oil could collapse to $65 a barrel by the end of the year, and analysts say it could slump to $45 by the middle of 2023 if a hard enough recession hits. Citi's outlook is based on an absence of any intervention by the OPEC Plus cartel and a decline in oil investments. Brent crude right now trading around $113. And this is one of, I think, the most interesting stories here, the conflicting calls, because JP Morgan says Russia may, out of spite, pull all of its 5 million barrels a day off the market, and that could drive the price to $380 a barrel, Danny. They say Russia has the economic stability to do that.
Yeah, the amount of air between $45 and $380 is massive. But Matt, look, I kind of am biased towards the upside because supply is still so tight. Katie, it's something we're grappling with. Even if you get demand low enough, how is that going to be enough in terms of supply? Because there's just not a lot there.
And when it comes to Citi's bear case, of course, it's that supply, the lack of oil investment that underlies it.
Yeah.
Yeah, oil investment is difficult in this environment. Coming up, Skylar Montgomery Koning, Senior Global Macro Strategist at TS Lombard. This is Bloomberg.
This is Bloomberg Surveillance, the early edition. Here's what you need to know. President Biden may be on the verge of rolling back some of the Trump-era tariffs on Chinese goods. Senior officials from the U.S. and China discussed the matter in their first talks since last fall. Ukraine will unveil a massive rebuilding plan this week. It may take hundreds of billions of dollars to recover from an invasion that has destroyed cities and shredded the economy. And parity in sight, the euro sinks to a 20-year low against the U.S. dollar. Investors paring bets on ECB interest rate hikes given the growth risk of recession in the region. I'm Danny Berger in London with Matt Miller and Katie Greifeld in New York. Both Anna Edwards and Kailey Leinz are off today. And Matt, Katie, we're getting some lines coming from the BOE's stress test. They're saying that the global outlook has deteriorated materially and that downside risks could hurt UK financial stability. So it is these recessionary fears that are filtering through the markets, also filtering through this stress test. They say the bank stress test, though, will commence in September. We'll recall that they delayed the current stress test because of all the macro environments. They're also talking about crypto, saying it's worth $900 billion, down from a peak of $3 trillion. There you go, Matt. More fodder for the crypto show next week.
Yeah, and at $1.20 for a pound, I'm just kicking myself that I didn't go to Wimbledon this year. I could have bought so much more stuff. I am looking right now at futures that are down, now getting a little bit more significant. 2/3% on S&P futures is the loss today. Maybe growing concerns about a deeper recession, or are we already in a recession? The 10-year yield coming down as investors buy that debt now to 2.88. Now it's unchanged, but you see that we're sort of changing direction in terms of the bond market right now. NYMEX crude is still up, which is slightly puzzling, especially with Citi's call for $65 a barrel. This could be a little bit of catch-up. Yesterday, of course, we were closed for the 4th of July for independence, celebrating our independence from the UK, whereas everyone else was open and trading. Brent certainly was trading. Bitcoin right now up 0.4%, so not a very big move for the digital currency, but right now at 19,839, hovering around that $20,000 level. Today, we're going to have a crypto show. I want to remind our viewers that at 1 p.m. today, we will be showing Bloomberg crypto, so definitely tune in for that. Katie, what do you see in terms of pre-market movers?
Well, if we go from macro to micro, I want to check back in on Carnival. I'm still thinking about that Morgan Stanley downgrade last week. Their base case, $7 a share. Their bear case, $0 per share. That's in the event of another demand shock. It's a rough day already for Carnival shares, down over 4%. Market's not even open. But if we look at Occidental, again, we learned late Friday that Warren Buffett's Berkshire Hathaway boosting its stake in Occidental. That has shares higher by over 1%, even as we see oil maybe start to fade some of those gains that we saw earlier in the European session. And Coinbase, man, it's trying to hold on, up 0.1% in the pre-market as Bitcoin maybe moves a little bit higher. But again, got some big downgrades last week. But Danny, what's interesting, actually, Coinbase still has 20 analysts who rate this stock a buy.
It's interesting. That's something we've seen across U.S. stocks, right? Analysts really taking their sweet time to downgrade over these macro pressures when it comes to the deterioration of earnings. Well, I got one mover for us in Europe. It's Uniper. Uniper up 2%, was up higher as much as 9% today. Uniper moving higher, according to people familiar, the German gas giant likely to get a bailout from the German government. The package might be as big as 9 billion euros, but it's not doing as strong today, getting caught up in the downdraft of the entire European equity market, down 0.8%. All of that stemming from the volatility we're seeing in the rates market and especially the FX market. Euro dollar, that's at 103.06. That is its lowest level in 20 years since December 2002. We're seeing a repricing on the front end of the curve. German two-year yields, those have dropped by about 10 basis points, undoing the moves that we saw yesterday. And it really is this global concern. Matt, I know you're looking at oil going higher, but the metals, for example, taking a hit today. Copper on the LME, that's down 2%. At a 16th month low, trading under $8,000, Matt.
All right, we're keeping our eye, obviously, on those. The metals coming down a lot more than the ags and certainly more than oils as well. Joining us now is Skylar Montgomery Koning, Senior Macro Strategist at TS Lombard. And we just got these headlines from the BOE that the global outlook deteriorated materially. Skylar, what do you expect in terms of a recession right now?
I mean, so it depends on what economy you're looking at. So for Europe, we've been calling for a recession for quite a while now because we saw this stagflation trifecta where you had, slowing growth because of China, but you also had slowing growth because of elevated energy prices and the Russia-Ukraine crisis as well. And then kind of over this year, we've shifted to calling for a recession in the U.S. as well, because you're starting to see, we have some leading indicators for jobs data that we're starting to see come off. We're getting a little bit more worried there generally. And we think the Fed will hike rapidly above neutral. And so our recession call for kind of end of this year, beginning of next year, is based off of the Fed tightening very rapidly. They're tightening above neutral to dampen demand. And so, we see a soft recession. It won't be very deep. It'll be a shallow recession. But I think, the markets are definitely focusing on the recession call, but maybe where they're less focused is what happens after, because if inflation is still elevated, you're not going to get that rebound. And you could have a very poor rebound.
Are we in a technical recession already, Skylar? I mean, the Atlanta Fed's GDP Now tracker says second quarter GDP was negative 2.1%. And of course, we had a contraction in the first quarter. Do you think we've had back-to-back contractions?
I mean, it's very possible. Our chief economist, Steve Blitz, thinks that, we'll get enough of a consumption shift this month and this quarter, rather, that, we won't get a negative print in the second quarter. But it is very much shifting in that worrying direction in terms of, as you say, that first quarter GDP print coming in negative. And you can have arguments over, it's trade, it's energy prices, it's whatever the moving factors are, but you can't negate the fact that was negative. And, the data is deteriorating rapidly, and so we could very well get a negative 2Q print.
It seems that we've spilled a lot of ink talking about the possibility of a U.S. recession, but Skylar, things are looking pretty ugly in Europe today, the euro sliding. Are you expecting euro-dollar parity?
Yes. I mean, we've been calling for this for a number of months. European growth prospects are just worse than they are in the U.S. And I think that the market rapidly moved to price Russia-Ukraine and then kind of stopped, which seems weird because, there's a very real risk that Russia turns off the taps as we head into the winter. And that would make sense in terms of from a tactical perspective for them to take that opportunity to cause the most economic pain. And so there are quite a lot of risks to European growth still. And we've always thought that the market had moved too quickly to price ECB hikes. The fact that we're getting kind of this anti-fragmentation tool means that they're likely getting more hikes than we expected at the beginning of the year, but they can't keep up with the Fed. And, in the U.S., the inflation dynamic is different in terms of its supply and demand driven. So Fed hikes actually do something to dampen demand where they don't in Europe. So we think, euro-dollar parity on the basis that you're not going to get the somewhat price policy convergence, and you will get a divergence in growth.
Skylar, the risk that you're describing, the risk that Russia turns off the gas taps to the rest of Europe, some of it has already happened. But in the case that it's 100%, it completely evaporates from the market. Walk me through what that means for the commodity space as a whole, because we've been talking about it, a lot of conflicting calls when it comes to where oil heads next.
Well, I mean, the problem is it's so bipolar, right? Bimodal in terms of you either get Russia completely turning off the taps and supply, and you get this rapid spike in oil markets, and we've kind of come off because people are seeing that, it's maybe a 30 to 40% reduction in supply to Europe, but it's not the kind of worst case scenarios that everyone was calling for. And so you've gotten that pullback in oil. You've also gotten that pullback in oil and the fact that demand is falling. You're getting increasing calls for a recession. People are really pricing that slowdown into next year. And so that's why you're having oil come off. But I think if you did get that natural gas cut off and that oil cut off from Russia, then you would see you get back to the highs that you were seeing in the initial Russia-Ukraine crisis spike. But, as I said, it's very bimodal in terms of if there is a resolution in Russia-Ukraine, that oil price is coming rapidly down. And so it's kind of stuck between these two drivers. And there's not really much you can do on the supply side because there isn't anyone that can come in and put in more supply that Russia takes out.
And Skylar, I want to quickly go back to the currency market because the story of this year arguably has been dollar strength. And if we do get to euro-dollar parity, first of all, I'm wondering what your timeline is there and how far past parity we could go. How far can the dollar really get?
I mean, I think a lot of it really depends on whether Russia-Ukraine gets worse and worse. And if it does get worse and worse, you can get significantly below parity. And so that timeline also depends on that. I think, we've kind of been testing this 104, 105 level, and we're just getting below that in the last couple of days. And that's kind of also a signal that we're getting past that technical resistance. And so you could see a rapid move lower on the back of that. But what I worry about in the coming months is this kind of revenge summer in Europe. And so this is the first summer that COVID restrictions have been completely off in Europe. And you're seeing a lot of consumption on the back of that. People are spending money. They're bringing down cash saving buffers. And because of that, you might get some good GDP data from Europe. And so, economic surprises have turned negative in Europe, but they are holding up better than they have been in the US. And so because of that, I think that might delay, getting significantly below euro-dollar parity. But if you get a complete capitulation, if you get a recession in Europe, which we expect at the end of this year, I think you'll get significantly below parity, especially, on those risk aversion, safe haven flows to dollar.
Skylar, great to get some time with you. Thanks so much for joining us this morning. Skylar Montgomery Koning there from TS Lombard. Coming up, natural gas now rivals oil as the fuel that shapes geopolitics. We'll discuss today's big take next. This is Bloomberg.
Live at the Principal Room. Coming up later today, Sam Stovall, Chief Investment Strategist at CFRA. That's at 8 a.m. New York time, 1 p.m. in London. This is Bloomberg.
We are working right now very actively to diversify our gas supplies. We are talking with other suppliers, both via pipelines like with Norway or LNG, where, for example, US has agreed to supply substantial additional amounts, also with many other countries, because clearly this risk is there. We already see Russia cutting gas supplies to a number of countries, so something we need to take seriously.
That was Valdis Dombrovskis, European Commission Executive Vice President, speaking with Bloomberg yesterday about gas shortages. They are rippling throughout the global economy, threatening recessions and a further wave of inflation. The commodity has soared 700% in Europe since the start of last year, becoming the driving force in a new Cold War. That's the subject of today's Big Take. Stephen Sepchinsky, Bloomberg energy reporter, co-wrote the story. And Stephen, who threw the first punch? I keep hearing that Russia is weaponizing energy supplies, but certainly they're doing that in response to the measures that were taken by the U.S. and Europe against them after the invasion of Ukraine, right?
Let me throw a third option out there and just say that I think the energy market, even before this war started, was already very, very tight. So you're going into a war, you're going into this situation with Ukraine with prices already at seasonal highs, record high in December for natural gas. And then the war in Ukraine exacerbates everything. And the problem is Europe did basically create their economy in a way where they were very dependent on cheap Russian gas. And so depending on who threw the first punch or not, Europe was in a position where they had no other choice but to depend on Russia after the war started. And now that Russia is starting to turn down the taps down 60% in the Nord Stream 1 pipeline, the key pipeline to Germany, you're seeing already a large impact on the European economy. The big utility in Germany, Uniper, is going to have to be bailed out by the government for 9 billion euros. That's a lot of money.
Yes, Stephen, we hear that 60% figure, a lot of the amount of gas that's been cut off from Russia going to Europe. But how do inventories actually look at the moment when it comes to natural gas?
So the inventories right now at this very moment are basically at the 5-year normal. So they were able to build up a lot of inventories in the first half of this year because Russia was still pumping gas. But now that gas isn't being pumped, the big question is, can you get to that 90% fill before winter? That was the target by the EU. And with basically Russia curbing output this significantly, it's going to be very challenging to fill that gap with, for example, U.S. LNG, Norway flows, U.S. Qatar LNG. There just isn't enough gas in the world to replace what Russia has provided for Europe. And because of that, they're in a very bad position in winter. And winter is when demand for gas, which is a heating and power plant fuel, peaks.
Well, Stephen, to that point, you write that to meet all the new demand, basically, it's going to require a massive wave of new investment. What's the outlook there? Are we actually going to see that massive wave, and who would even lead it?
So we're already seeing a pretty big wave, and it's coming out of Qatar and the United States in terms of supply. So Qatar they've already planned this for years, but they're moving forward with this massive LNG export expansion. The U.S. as well, there are 2 private companies in the U.S. that are developing LNG export terminals, and 2 projects were approved. There are about a dozen more projects in the U.S. that could get final investment decision, which is the step before actually building the facility. But the problem with this supply is it doesn't come online by winter. It comes online by like 2026, 2027. So in the near term, there just is no more gas. And in the near term, the way to balance the market is to consume less. And that's something that's going to be challenging for industries and households alike.
Speaking of industry, Stephen, what would a Uniper bailout look like, and how likely is it?
So the Uniper bailout will be 9 billion euros. And it's not exactly clear how it will move forward, but there was some laws that were passed during COVID times that allowed for the government to basically bail out, take ownership to some extent, the shares of a company, and then they would say, okay, you're not going to issue any new dividends, you're not going to give any bonuses, you're going to keep things lean, and we're going to help you get through this. Now, over the next few weeks, we're going to see the details of the bailout, but Uniper is losing 30 million euros a day because of the drop in supply from Russia, and they need more cash from the government, and fast. And so that's something that's going to be something everyone's going to be watching over the next few weeks.
Stephen, thank you very much. That's Bloomberg's Stephen Stupczynski. And of course, to read Stephen's story, it's our Big Take today. NI Big Take Go is where you want to head on your terminal. And a programming note, because I'm sure you've not had enough of Matt Miller today. Be sure to catch Bloomberg Crypto today at 1 p.m. New York time, 6 p.m. in London. Our weekly show covers the people, transactions, and technology shaping the world of decentralized finance. This is Bloomberg.
High inflation is probably worse over the very long term.
At this point, inflation rules the game.
That's why the Fed is committed to really curtailing the inflation. That's the bigger problem right now.
This risk of entrenchment where inflation fears are in your head and you just expect it to keep happening is elevated.
Now markets are shifting away from inflation worries.
I think it's recession risks.
Markets are not yet sure, so that's why you see this hic-hac going on in the markets, but actually we are at this tipping point.
I think recession's a bigger risk by now because inflation is priced in now, right? We're all aware we're in a high inflationary environment. People are adjusting their budgets, but recession's what's going to turn this market over.
I disagree on the recession risk in the United States, frankly. I think people are talking themselves into a tizzy here about a recession.
The recession-proof strategies that investors used in the last economic cycle, things like cash and high-grade bonds and treasuries, those just cannot be the strategies that you go full force into in a time when inflation is high.
Investors and economists there weighing the risks of recession and inflation. Let's add another smart voice to the mix. It's Tom Keene, co-anchor of Bloomberg Surveillance, who joins us now. Tom, we're all over here obsessing over a euro dollar with a 102 handle. I know you got your eye on DXY.
Well, I do. I'm looking at DXY. There's two major dollar indexes. The Bloomberg index is the best one. It's the best math. It's deeper. It's got EM in it. DXY is an ancient one, Danny, going way back, which is major trading partners. I think euro's 54 or 57% of it. And it's breaking out. Let me cut to the chase. When do we get to a Plaza Accord angst? On a log chart, you look at the length of the arrow off the trough of the 70s up to the Plaza Accord, and then you drag the same arrow over, and it tells you where the angst clicks in. We are 12% stronger dollar from a Plaza Accord equivalent, looking at a 40-year trend. So that's the mathematics. But the answer is all of a sudden, Danny, through all the surveillance, second half of 2022, we have to look at currency.
And Tom, we're minutes away from the start of surveillance. When you look across your guest lineup, who are you most excited to talk to today?
Well, there's any number of people that we want to talk to. We've been, I think Amrita Sen on oil is going to be really fundamental for us, with Brent crude 112 down from a 124 level.
Tom Keene, thank you so much. And before we get there, let's look at what we're looking ahead to today. I'm keeping an eye, of course, on U.S. data. We do have factory orders coming up at 10 o'clock, as to durable goods orders. And Danny, as we talk about recession fears, where the consumer is, where demand is, this is really important.
It certainly is. And look, because the data has been so volatile and because the Fed has said that they are continuing to be data dependent, we're all looking for signs of recession to see if it could cause the Fed to pause. I personally think that might be unrealistic, given that they want to bring demand down in line with supply. So demand weakening would be a feature, not necessarily a bug of what we're seeing them do. Katie, though, I personally am looking at what's going to happen with China when it comes to tariff developments and the U.S. We learned that overnight Janet Yellen and Li He held a call. They talked about tariffs. They talked about sanctions. It started out with some excitement. There were some reports that we could see a lifting of Trump-era tariffs, but that excitement quickly faded. Barclays saying it would only take away about 0.3% of inflation. Of course, part of the reason that sentiment faded has to be with what's happening in bonds, Katie.
Absolutely. I mean, we'll see if Barclays is right, and if we do get a rollback, what it actually means for inflation, whether it's de minimis. But really interesting to see the price action in bonds. We do see yields a little bit higher today, but of course that's after a huge rally last week when it came for treasuries and global bonds as well. Again, seems like that rally is taking a little bit of a breather today, but when we talk about recession fears, that is front and center when it comes to the bond market.
And, of course, front and center with the euro, we must make the point, euro trading at a 102 handle, just under 103, its weakest level since 2002. That conversation will continue as Bloomberg Surveillance continues. This is Bloomberg.